If you owed taxes this year, there's a pretty good chance your first thought was, I need to increase my withholding. And honestly, that makes sense. If you owed money when you filed, it feels like not enough was coming out of your paycheck, so the natural reaction is to tell payroll to take more. And sometimes that is part of the solution. But here's the problem. For a lot of middle-class households, that response is incomplete. Because increasing withholding may help you avoid owing again next time, but it does not actually reduce your tax burden. And that distinction matters. A lot. Because there's another move that many people don't think about first. Increasing traditional pre-tax retirement contributions, especially through a traditional 401k. That move does something extra withholding can't do. It can reduce your current taxable income. So today we're going to break this down clearly. We'll cover the difference between increasing withholding and increasing traditional 401k contributions, why so many people default to the wrong option first, when withholding still makes sense, when 401k contributions make more sense, and when the smartest answer is actually both. Quick note before we start. This video is for educational and entertainment purposes only. I'm not a financial advisor, CPA, or attorney, and this is not financial, tax, or legal advice. Tax rules change, personal situations vary, and state taxes can make the math look different. All right, let's start with the core misunderstanding. Withholding and tax liability are not the same thing. Withholding is just how much of your paycheck gets sent to the IRS during the year. That's payment timing. It is not automatically tax reduction. Think about it like this. If your total restaurant bill is $100 and you pay $80 during the meal and $20 at the end, your bill is still $100. If you pay $95 during the meal and only $5 at the end, your bill is still $100. The payment timing changed. The bill did not. That's what withholding does. It changes how much gets prepaid. It doesn't necessarily change the size of the bill itself. Traditional 401k contributions are different. Those can reduce the income that gets exposed to current federal income tax. Completely different mechanism. And once you see that difference clearly, a lot of tax decisions start making more sense. Now let's talk about why people default to withholding. Because honestly, it's simple. You owe taxes. You get annoyed. You tell payroll to take out more. Done. No deeper planning required. No trade-off discussion. No retirement allocation decision. No debate about cash flow. It feels clean, immediate, and practical. And sometimes it is necessary. If your withholding is way off because of bonuses, side income, spouse income, or old W-4 settings, then yes, fixing withholding matters, especially if you're trying to avoid another surprise bill or an underpayment issue. But that still doesn't answer the tax efficiency question. And the tax efficiency question is this: if I have extra room in my budget, what's the smarter option to execute first? For many working households, the answer is not just withhold more. The answer is, first ask whether more of that money should be shifted into traditional pre-tax savings. Now let's walk through why. When you contribute more to a traditional 401k, you're often lowering current taxable income for federal income tax purposes. For 2026, the employee contribution limit is $24,500. With catch-up contributions allowed for eligible older workers. And if you're watching this later, those limits may be higher, so check your plan and the current IRS limits. Here's the key idea. If you're in, say, the 22% marginal bracket, every extra pre-tax dollar may save roughly 22 cents in current federal income tax. If you're in the 24% bracket, that same dollar may save roughly 24 cents. Not on every dollar you make. On the next marginal dollars that fall into that bracket, that distinction matters. Now let's make this concrete with realistic middle-class style examples. Example 1. Let's say a married couple has combined household income of $110,000 and takes the standard deduction. For 2026, the married filing jointly standard deduction is $32,200. That puts their rough taxable income around $77,800 before considering other pre-tax items, which places their top marginal dollars in the 12% federal bracket under the 2026 thresholds. So what happens if they owed taxes and decide to fix it by increasing withholding? Their paychecks get smaller. Their April surprise may shrink, but their taxable income doesn't meaningfully change just because payroll held back more money. Now, what if instead they increase a traditional 401k by $5,000 for the year? Their rough taxable income drops from about $77,800 to about $72,800. And if those dollars are being avoided at a 12% marginal rate, that could mean around $600 in federal tax reduction. Not massive, but real. And they also increased retirement savings at the same time. That's the key idea. Withholding solves the filing time pain. Traditional 401k contributions can help solve the tax efficiency side. Example 2. Let's say a couple earns $180,000 combined and takes the standard deduction. Rough taxable income would be about $147,800, placing their top marginal dollars in the 22% bracket under 2026 married filing jointly thresholds. If that couple owes taxes and simply adds extra withholding, they may avoid the next April bill. But again, that doesn't lower the actual tax calculation. If instead they increased traditional 401k contributions by $10,000 for the year, and those dollars are avoided at roughly a 22% marginal rate, that could lower current federal income tax by about $2,200. Again, simplified, but it makes the point. There's a difference between sending more money to the IRS and reducing the income being taxed. Example 3. Let's use a household at $258,000, similar to the income example we discussed earlier. Assume married filing jointly and the standard deduction. Using the 2026 standard deduction of $32,200, rough taxable income would be about $225,800 before other adjustments. And since the 24% bracket for married filing jointly begins above $206,700, some of that household's top income is now sitting in the 24% range. That means the first portion of additional traditional 401k contributions could be avoiding tax at around 24%, before eventually dropping later marginal dollars into the 22% range. So if that household increases traditional 401k contributions by $12,000 for the year, the federal tax reduction could be in the neighborhood of roughly $2,700 to $2,900 depending on where those dollars fall. That's not a refund trick, that's not payment timing. That's a real reduction in current taxable exposure. And that's exactly why this conversation matters. Now, at this point, some people will say, okay, but if I increase my 401k, I could still owe taxes, right? Yes, absolutely, because these are different tools solving different problems. If your W-4 is wrong, if your spouse's withholding is off, if you had bonuses, if you had side income, if you sold assets, or if other income showed up during the year, your withholding may still need to be adjusted. That's why I don't want to oversimplify this. This isn't a video saying withholding is bad. It's a video saying withholding is often misunderstood. There are really 3 situations here. First, you don't save enough for retirement and you owe taxes. In that case, increasing traditional 401k contributions is often the stronger first move because it helps long-term savings and may reduce current taxable income. Second, you already save aggressively, but your paycheck withholding is simply inaccurate. Maybe one spouse changed jobs. Maybe bonus withholding wasn't enough. Maybe the W-4 settings were outdated. In that case, the main fix may be withholding. Third, you owe taxes because income rose and you also have room to improve tax efficiency. That's where the best answer is often both. Increase traditional pre-tax contributions enough to reduce taxable income, then update withholding enough to make the year-end result cleaner. That's the mature version of the strategy. Not this or that thinking, but understanding what each option actually does. Now let's talk about one of the biggest middle-class traps here. Two-income households. This is where a lot of people get caught off guard. One spouse has withholding, the other spouse has withholding. Both jobs seem like they're taking taxes out, so everybody assumes they're covered. But payroll systems aren't reading your full household story the way you think they are. That's one reason the IRS points taxpayers to the tax withholding estimator to help align withholding more accurately and update Form W-4 when needed. That tool matters. But again, it solves withholding accuracy, not necessarily tax reduction. And that's the framework I want you to remember. Ask two separate questions. Question 1, how do I make my tax bill lower if I legally can? Question 2, how do I make sure I'm not underpaying through the year? Related, yes, but not identical. Now let's add one more layer. What about an HSA? If you're eligible for an HSA through a qualifying high-deductible health plan, that can be another powerful pre-tax option. For 2026, the HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage, plus catch-up contributions for eligible individuals age 55 and older. And again, check current limits if you're watching this later. So for some households, the smarter order may look like this. Capture the employer match, fund the HSA if eligible, increase the traditional 401k, then fix withholding. Your exact order may vary, but the important lesson is that owe taxes shouldn't automatically trigger only one response. You want to diagnose the cause. Was the problem just under withholding? Was the problem higher income? Was it bonuses or variable pay? Or was the real missed opportunity that you left pre-tax space unused all year? Those are different problems, and they deserve different solutions. Now, when is extra withholding still the right first move? 1. When you already contribute heavily to retirement and you don't want to lock up more cash. Cash flow matters. If increasing your 401k creates a monthly squeeze that causes other problems, that's not a win. 2. Withholding may need to come first if you had a large underpayment issue and you need a cleaner paycheck to tax setup right away. 3. If your tax issue is coming from income that isn't being withheld properly, then withholding or estimated payments may need attention regardless of how much you contribute to retirement. So the strategy isn't always 401k. It's know what tool solves what problem. That's the whole game. And that leads to the final framework. If you owe taxes, don't ask only, how do I stop owing? Also ask, am I using the most efficient option available to me? Because if the answer is no, you may be defaulting to a simpler fix while missing a smarter one. So here's the takeaway I'd give to almost any household. If you owe taxes and you're not saving enough for retirement, start by looking at traditional pre-tax contributions. If you owe taxes and your withholding is obviously misaligned, fix withholding. If you owe taxes and both are true, use both. Reduce taxable income where you reasonably can, then recalibrate withholding so you don't keep getting surprised. That's the difference between reacting and planning. And that's how you stop treating taxes like a once-a-year emergency and start using them as part of a broader money system. Because the goal isn't just to avoid pain in April. The goal is to build a structure that improves cash flow, improves tax efficiency, and strengthens your long-term position at the same time. That's a much better mindset than just saying, take more out of my check. If this helped clarify the difference between withholding and actual tax reduction, please like the video. It really helps the channel. And subscribe to Built Not Lucky Finance for for more no-fluff breakdowns of personal finance basics. And if you know someone who'd benefit from this, share it with them. And if you've ever owed taxes and immediately defaulted to extra withholding, drop a comment and tell me, because a lot of people have. And once you understand the different options available to you, you can make much better decisions going forward. Thanks for your time.